might be debt, might be government spending, might be kind of an unemployment problem, right? This jobless recovery that we seem to be in. And the solution to this triple crisis is what? More, right? More growth. We got to grow the economy. All our models, all our policies, everything depends upon some kind of getting back to some kind of normal growth rate. And we can grow our way out of a debt problem, grow our way out of a spending problem, grow our way out of an unemployment problem. Okay? So the holy grail of the triple crisis is economic growth. I'm going to make the case that we're in a different triple crisis. The real triple crisis is indeed economic. Okay, so we have some serious economic issues. The structure of our economy, the function of our economy, this debt-based monetary system that we've created that sort of all points to a system that really requires infinite growth to work, to function. This is a problem when we think about the other parts of my triple crisis, okay, which is also a resource crisis and an environmental crisis. So I want to spend a little time unpacking that and then getting back to that notion of, is economic growth going to solve these three things? So let's start with the economic crisis. Certainly we are taking on some debt. Okay, this is an historical view of our debt. Looking at the Congressional Budget Office data, going all the way back to estimates at the U.S. Revolution through these various periods of time in our society. And we are somewhere up in here in 2012, 2013, approaching World War II levels of debt, where we peaked above, okay, it was the highest sort of debt ratio in our country's history, 109% of GDP. So we grew our way out of the Great Depression. We spent a lot of money. World War II helped us get out of the Great Depression, and we did so by borrowing a lot of money. And then we paid it off, right? We paid it off through growth. Thank you. All right, you guys are starting to catch on here. We grew, right? We grew like crazy. We grew the largest middle class that the world had ever seen. We grew the largest economy that the world had ever seen. We did this growth through an amazing combination of labor productivity, technology, resource exploitation, trade. We grew, we paid back this debt. And then it started to pile up again, and then we get into the Great Recession, and we've really taken on some debt, and there's some various projections here of going forward that aren't all that rosy on the debt scenario side of things. This is where we are now in 2011, 2012. You know, if you look at our outlays and how much our government is spending versus the revenues that it takes in, we've got this growing gap. So in modern times, really going back to 1971 here, we have this growing gap. And we're going to fix it through growth. Okay, so we're going to grow. We're going to grow. So all of these CBO estimates includes growth that brings our revenues back up, and then we're going to control some of our spending, control some of our costs, but we're largely going to fix this through growth. This is how we sort of grew out of that last major debt buildup coming out of World War II, is we redistributed huge sums of wealth in our country throughout society, right? We did it in sort of a shared way. We grew in a very middle America way. We took wealth, so pre-Great Depression, we've never seen wealth levels that was concentrated in the hands of so few. Right? 44% estimate wealth and 1% of the US population. The Great Depression sort of broke that bubble, as the Great Recession did this time around. We were seeing similar numbers coming into the Great Recession. A lot of us were going, uh-oh. If you just rocked the boat on this 1% of America, we could see a huge bubble burst here. And that wealth, you know, still 21% of the country's wealth in 1% of hands, you know, some people still might think that's a lot. 81 was a game changer for our country, and we flipped the switch and we went back the other way. Okay? So we started to concentrate wealth in the hands of the few. And we did this in a very purposeful way, a policy-designed way. You guys all have heard of trickle-down economics and the kinds of policy changes that we did to say our growth model now for the 80s and 90s is going to be to really sort of stack the deck in favor of a wealthy class. If you look at this in terms of income, so here is 1947, post-World War II to 1979, some analysis by Michelle and Bernstein. Break the US population up into equal quintiles, and you see that that period, we grew fairly in a sort of equitable way, right? Each of these 20 percentiles of people was growing on the order of, and this is in real dollars, so taking out inflation, 160%, 114%. In fact, the wealthiest groups here were growing the least. And here you break out the top 5%, and the growth was smaller than all of these other quintiles. So 1979, 1980, magic time here in our country's history. We flipped the switch, okay? This is what it looked like throughout the 80s and throughout the 90s into the better part of the last decade. The lower quintiles are either not keeping up or barely keeping up in real terms, so keeping up with inflation. And a lot of the growth of incomes that we saw in our country was really in that top 5%. Quite a different story than the growth model coming out of World War II. We also, in this more recent period of growth, saw major productivity gains. But that productivity wasn't widely shared across the economy because we saw real hourly compensation and real hourly earnings either flatten or decline. So real here is a term that's used to sort of say take inflation out, right? Really get a sense of what your earnings can really buy for you. And real hourly earnings, when you don't worry about all the other compensation on top of earnings, has been in decline really since the mid-70s. Yet productivity is going up and up and up and up and up. So where does the extra return on labor going? What is happening to it? It's not going to the worker. It's not going to the wage. Where is this extra sort of productivity of this amazing growth experiment of the United States economy going?
Management and stockholders.
Management and stockholders. So one of the switches that we flipped, right, was to really gear our tax towards rewarding capital gains, right, and really punishing labor gains. And so that was one of the sort of things that happened, and why we saw that really lopsided growth pattern happen as compared to post-World War II up to 79, 80, and ever since. This really relates to the second crisis, the resource crisis. Because the other way, the miracle of the growth system, the U.S. growth economy post-World War II, was energy. Our country, our nation, had more oil resources than any other country in the history of the economy, the history of the planet. We had the most, and we also blew through it the fastest. And we were really good at this. And we had energy resources that piled high really helped us grow our way out of that huge debt burden that we had taken on leading up to World War II. So I want to tell you a bit about that story and how that's changing as well. This is some industry analysis. Energy data is so hard to come by because it's all controlled by industry or national industry, which is even harder to get some of that data. So you got to wring this out of the energy consultants. But this is energy production per capita looking across the world, okay? So it's growing until about 1979, and we've seen this kind of plateau for energy production per capita. Now you might say, well, that's no big deal. We can grow without more energy because we're becoming more efficient, right? We're becoming more efficient. I'm going to break that myth here in a second. Also, if you look at world energy production, so this is energy production per capita, world energy production stopped growing exponentially by 1970. Okay, this is a really interesting sort of break in our country and the world's history as we have become, I will argue, more dependent on energy than ever before, yet it's not growing exponentially anymore. Yet GDP continued to grow exponentially throughout the 80s, throughout the 90s, population continued to grow exponentially, but energy is not keeping up anymore. Okay, so this is going to have to somehow affect the growth model of the 80s and 90s versus the growth model of the 50s and 60s. Part of the story, of course, is the peaking of oil supplies. So we've done thorough analysis of the big oil producers throughout the world, and you see these years when all of these countries, the U.S. outside of Alaska peaked in 1971, as M. King Humber said it would back in the 1950s. You add Alaska, we peaked at 89. Of course, with the current oil prices, we're getting into a new kind of peak, and I'll talk about that in a second. All of these other major oil countries have peaked and have extended recently this peak oil curve out a little bit farther, but through very unconventional oil supplies.